Understanding net present value, NPV. Net present value, NPV, is a cornerstone concept in finance and investment analysis. It serves as a vital metric for evaluating the profitability of projects, investments, or business cash flows. NPV calculates the difference between the present value of cash inflows and outflows over a specific period, adjusted for the time value of money. This calculation helps decision-makers discern whether an investment will yield sufficient returns to justify the initial costs. Key concepts of net present value. Definition and importance. NPV is fundamentally rooted in the principle of the time value of money, the idea that $1 received today is worth more than $1 received in the future. This is due to the potential earning capacity of money, influenced by factors such as interest rates and inflation. In capital budgeting and investment planning, NPV acts as a guiding tool, enabling firms and investors to analyze the projected profitability of a given venture. Positive versus negative NPV. When assessing NPV, a positive value indicates that the projected earnings surpass the anticipated expenses, suggesting a potentially profitable venture. Conversely, a negative NPV signals that the investment may lead to losses, making it prudent to steer clear of such opportunities. Calculating NPV. NPV formula. The calculation of NPV can be expressed through two formulas, depending on the nature of the cash flows. 1. Single cash flow NPV calculation. NPV equals frac, cash flow, open parenthesis 1 plus I close parenthesis to the power of T, initial investment. Where I is the required return or discount rate. T is the number of time periods. 2. Multiple cash flows NPV calculation. NPV equals sum underscore T equals 0, caret N a frac R underscore T open parenthesis 1 plus I close parenthesis to the power of T. Where R underscore T is the net cash inflow or outflow during a period. I is the discount rate. T is the number of time periods. This summation enables a comprehensive assessment of projects involving recurring cash flows over time. Determining cash flows and discount rate. Estimating cash flows and determining an appropriate discount rate, often based on the cost of capital, are both critical to performing an accurate NPV calculation. For instance, assessing cash flows involves projecting anticipated revenues and costs over the investment period, while the discount rate reflects the opportunity cost of capital, indicating potential returns from alternative investments or the firm's weighted average cost of capital, WACC. Applications of NPV. Investment decision-making. NPV provides a quantitative basis for choosing between different investment opportunities. By calculating the NPV of multiple projects, companies can allocate resources effectively and focus on those ventures that offer the highest potential for profitability. Capital budgeting. Within corporate finance, NPV serves as an essential tool for capital budgeting. It assists in evaluating large-scale projects, such as capital expenditures and new product developments, which may entail significant upfront costs and extended timelines. Comparative analysis. NPV is particularly valuable in comparing the financial viability of different projects or investments that may vary in their duration and cash inflow profiles. Financial analysts often perform NPV assessments as part of a discounted cash flow (DCF) analysis, further aiding comprehensive valuation strategies. NPV in practice, Excel implementation. Excel features built-in functions to simplify the NPV calculation process. Using the NPV function, you can model future cash flows and compute present values efficiently. The general syntax is Excel equals NPV, discount underscore rate, value 1, value 2. Users can easily input estimated future cash flows and calculate NPV swiftly, enhancing financial modeling capabilities. Limitations of NPV. While NPV is a robust financial metric, it is not without its limitations. 1. Assumptions on cash flows. NPV relies on forecasts about future cash flows, which can be uncertain. Overly optimistic projections can skew results. 2. Judgment call on discount rate. Selecting an appropriate discount rate is crucial and can significantly influence NPV results. The choice may also depend on market conditions and individual risk appetite. 3. Neglect of project size. NPV yields a dollar value but doesn't reflect the scale of an investment. Comparing a small project with a high NPV against a larger investment with a lower NPV can lead to misleading conclusions. NPV versus other financial metrics. NPV versus payback period. Unlike NPV, the payback period measures the time it takes to recoup an initial investment without considering the time value of money. While it offers a simple overview of liquidity risk, it fails to account for longer-term profitability. NPV versus internal rate of return, IRR. The IRR is the discount rate at which the NPV equals zero, serving as a percentage measure of an investment's earnability. While IRR provides insights into profitability, it can be misleading in projects with non-conventional cash flows where multiple IRRs could exist. Conclusion. Net present value is an indispensable tool in capital budgeting and investment analysis, helping businesses and investors assess potential profitability against the costs invested. A positive NPV indicates a promising opportunity, while a negative one warns against potential financial loss. By understanding and applying NPV, stakeholders can make informed decisions, ensuring efficient allocation of resources toward ventures that maximize value creation.